Best annual review and preview report on the U.S. property casualty industry notes that 2025 was the strongest year the segment has seen in the past decade. Here to discuss the report and preview 2026 is Jackie Lentz, Senior Director, and David Blades, Associate Director, Industry Research and Analytics, both of AM Best. So Jackie, what drove the positive performance in 2025?
The positive performance for the U.S. property casualty industry in 2025 was driven by a combination of factors. First, we saw disciplined underwriting execution, along with rate increases across lines. Personal auto and homeowner rate actions drove earned premium growth in both 2024 and 2025. Although workers' comp was the only line that saw negative premium growth, it does remain profitable. Second, we had moderate catastrophe losses. Despite January 2025 California wildfires, the rest of the year was relatively benign. No significant hurricanes made landfall during the season, which stabilized property results. And then lastly, on the investment side, we saw strong investment income. Some higher reinvestment yields and solid equity market performance led to double-digit growth in investment income, providing a crucial buffer for underwriting margins. So these factors really anchored the results as companies navigated headwinds like elevated loss costs, adverse prior year reserve development, and social inflation.
Jackie, as we move through 2026, do you expect these trends to continue?
Yes, several positive trends from 2025 are expected to continue into 2026. Although we may see some continued pressures, we expect investment income to remain strong. Higher reinvestment yields are projected to continue to support earnings, even as underwriting margins thin somewhat. There is still rate momentum carrying some lines forward, which will help offset elevated claim costs. But this rate action is expected to slow down relative to 2025. There are some persistent headwinds, though. Companies face growing competition, social inflation, and issues related to litigation financing. With respect to catastrophe losses, similar to 2025, which started with California wildfires, 2026 started with Winter Storm Fern, which blanketed much of the continental U.S. with snow, ice, and sleet. So while this event may be manageable at some point in time, we may see some constrained profitability for this event for insurers. The bottom line, though, is that underwriting discipline is still critical for full year 2026. And while underwriting results may remain favorable, there are some challenges that will test the resilience of companies.
David, what are the P&C lines of business that you're concerned about?
So, as mentioned in the report, the only lines that we currently have a negative outlook on are commercial auto and general liability of the major lines. We also have a negative outlook on the title industry as well. From a commercial auto and general liability standpoint, as Jackie mentioned, social inflation and third-party litigation funding are some of the issues that have been causing increased claim costs and increased loss severity. And so, those have been, focus for us. Specific to commercial auto has been the most confounding line of business for PC insurers for a long time. Consistent underwriting losses, and although measures have been taken to have been implemented to enhance results recently, and we've seen some incremental improvement, it's still probably the most consistently unprofitable line. Social inflation, like I said, is one of the factors that's been impacting commercial auto. But some of the more foundational issues have been rising repair costs for vehicles, especially those that have like the newer technology in them, and also rising labor costs relative to the skilled technicians that are needed for the auto physical damage, repair. And so we've seen some safety measures that definitely have impacted and helped commercial auto from a loss frequency perspective. But again, from a loss severity perspective, we're still seeing claim severity trends going, in a negative direction. And again, that's had an impact on commercial auto and on loss reserve development from prior years that we've seen impacting that line. So that's one of the lines that we keep our eye on. From a general liability standpoint, as we mentioned, third-party litigation funding and social inflation have definitely been some of the issues. But secondarily, drivers that have been impactful from a general liability standpoint have been some of the emerging classes of litigation that might lend to class action suits. And so some of those litigation exposures are some of the things that are really tough to underwrite and price for. And so we're seeing how they've been impactful in terms of underwriting results and in terms of actually seeing the loss reserve development, how they've been factoring in on open claims and impacting that as well. So when you put together the commercial auto concerns with the general liability concerns, they've led to issues with regards to umbrella and excess liability coverage, because again, those are coverages and policies that are over the commercial auto and general liability policies. So from that standpoint, we've seen more in terms of the large, the factors that have led to larger verdicts and the nuclear verdicts, if you will. And so those are some of the things that we're seeing impactful. Obviously, it's commercial auto and general liability that have impacted some of those larger verdicts. And so they've pierced some of the initial, excess liability or umbrella, umbrella levels, and they've caused insurers to, engage different strategies and different pricing strategies and different structure strategies in terms of how they're looking at excess liability and umbrella. So those are a couple of things we're focused on. We mentioned in the report, for a number of years, we've looked at workers' comp. Workers' comp has been, one of the biggest drivers of profitability from the standpoint of property casualty industry and property casualty insurers. But because of consistent rate declines, we've seen the profit margins slim a little bit, and we've also seen a little weakening in terms of the loss reserve cushion that has benefited workers' comp and in terms has benefited the overall personal property casualty industry. So those are some of the lines that we're looking at and we'll continue to monitor for our insurers as we look forward.
David, are there other headwinds that could dampen performance in 2026?
Well, when I look back at 2025 and think about, all right, what we're looking at 2026, obviously there was a relatively benign Atlantic hurricane season. So if we had an Atlantic hurricane season or a cat year overall, that's a little bit more in line with what we've seen, let's say in 2024 when Hurricanes Helene and Milton actually made landfall, whereas in 2025 we didn't have any landfalling hurricanes. A more active cat year could pressure profit margins from that standpoint. So that's one of the things we're looking at. We saw rate and pricing trends on a number of lines moderate or even soften in 2025 or towards the end of 2025 and going into 26. And we think that may put some pressure on profit margins on those lines as well. So that's something we'll look at. And then any expansions of any geopolitical tensions and what that could mean from a supply chain standpoint, and where that may have any impact on the bottom line, whether it's claim costs or anything else that's negatively impacting any of our insurance companies. We'll continue to look at that as well. And I think just in general, as Jackie mentioned, even with some of those potential headwinds, looking at insurer balance sheets and how they've been strengthened, or the strength of those balance sheets and the benefit that our insurers have seen from investment returns the last few years, I think we see the overall property casualty industry and those insurers as being strong in that regard. And again, probably be able to withstand these headwinds, but it's something that we'll monitor on a company by company basis. And the companies that have been less successful at monitoring some of that volatility, whether it's climate or weather related, or whether it's due to any macroeconomic factors, those will be the companies that would potentially face rating pressure as we look forward.
Jackie and David, wonderful to see you. It's been a pleasure. Thank you both so much for taking the time to speak with us today. Greatly appreciate it.
Thank you.
You're welcome, Lori.
That was Jackie Lentz, Senior Director, and David Blades, Associate Director, Industry Research and Analytics, both of AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm Lori Chortis.